I did exactly what I told myself 1,000 times not to do. Don't be trigger happy. And I did it again yesterday, knowing better. Reasons why I shouldn't be trigger happy. I'm going to talk about that. Let's jump in. Yesterday's video, I talked about planning to get into Oracle. Oracle's been hit. It's gone down 45% from its all-time high. And I think it could go down lower, down to 170 strike price, right? So currently it's at about 182-ish. And so I put a lower bid price in using put options. And I talked about that strategy. And I'm glad I did that because if I'm this trigger happy and I bought at 182 and the price keeps going down to 170, that's a difference of $1,200 if I buy 100 shares. At the same time, it's double-edged knife. When I sell put option, I feel more confident, more arrogant. Yeah, I'm getting in at safer prices, which is true, but it also makes me lower my safeguards. And that's exactly what happened yesterday. I planned a trade. I had a premium limit order that I was going to sell it at 65 for 170 strike price. Not a whole lot. I'm not trying to hit a home run and collect lottery tickets on every hits. It's more like base hits, not home run swings. And so I collect these weekly payouts, right? And pocket these payouts every week and just let those stack up little by little. $65. Market opens, stop goes down pretty low, and then from there it starts picking up. It didn't hit my target $65 premium. And I think it went to about 60-ish. Close, but not enough. And so what do? I go in there and I sabotage my trade. That's basically what I did. It's just Monday, and we still have Tuesday, Wednesday, Thursday, Friday, the full week for my trading plan to work out. So I lower my bid price for the premium and only take $45, take one third less because I don't think Oracle will go any lower at that time. Of course, I was wrong because as soon as I executed that trade at a lower price, Oracle did go down and volatility picked up, making it even more expensive. On top of that, a little bit of revenge trading. So I decided to sell another put. So I'm doubling my position size. And ultimately, I sold it for a bit over $1. And so the average price premium that I got was 70 cents, $70 per contract. So I collected $140. Now, $170 strike price, current price being at about 182, not the best trade. Obviously, I'm doubling my position size because as you know, when you sell a put option, I had spoken about this in previous video, you set aside collateral. $170 per share, $17,000 per 100 share, which is the equivalent of one contract. Double that, that's $34,000 I put aside. Now, of course, I have reasons for this. I did my technical analysis chart read. 170 is a fair price. And of course, there's gaps up. And plus, Oracle, I don't mind owning the stock. Probably not 200 shares. 100 shares would be sufficient. That would give me more leg room in case the price goes down to my next target price level at 150. Then I could buy another set of options by selling another contract and average my price in. So I sidestepped all of my rules. That was number one, sabotaging my trade plan. Number two, just knowing better. I had spoken in previous video that I recorded and shared with everyone, speaking out loud. and I knew that the market still had some ways to go down. When I talk about the market, I'm talking about NASDAQ Composite, the broader index. And going back to what I had talked about previously, I'll touch upon it very quickly. Here's a post that I made last week. We still need a back test of NASDAQ. It broke out of the downtrend. And generally, to confirm that it's switching from a downtrend to an uptrend, we need a back test. And I put minus 5%. And so far, NASDAQ's been going down, but not even close to minus 5%. So we still have some ways to go. That's number two. Always check the broader market before putting on trades. And I knew this in the back of my mind, but at the same time, I felt that Oracle somewhat bottomed out, pretty low RSI, and that's fair. Maybe I could have just been okay with the one position size, but I doubled up thinking that, hey, I feel extra good about this and I'm super confident, but of course, that's arrogance. And number three, take a look at this. It's OPEX week. The third Friday of each month is options expiration week. And this is especially when the volatility is super high. So the price for all different stocks, ETFs, everything can swing pretty wildly, which means premiums are much higher. So I sold premium pretty much at the open on Monday, and then there's a full week still left, and that premium can swing a lot higher prices. I can get a lot better payouts if I stayed a little bit more patient and waited. We'll have to see how Oracle plays out, right? But $170 is not that far away from 182, the current sitting price. It's gone down quite a bit, but looking at the charts, here's a daily chart of Oracle. It's under 30, so it's pretty oversold. Could be lower, could be 25-ish. And excuse me, not 182, 185 is the current price. And if we're looking at 170, which sits right about here, right at about local support. However, if we zoom out, look at that. 150-ish would be the next support level. Target price for me. So it's not just you, it's me too. I get trigger happy, I get impatient, and at the moment, I override just the things that I know better not to do, but I still do it, thinking that options gives me that extra protection, and so I don't have to worry as much and I can lower my safeguards, but that's not true. That's not the case. And going back to the third point, here's the kicker. Not only is it OPEX week, it's triple witching. Triple witching happens 4 times a year, March, June, September, December. This one, I should have known better. Triple witching. And you should always mark this on your calendar whenever you trade options and even stocks or even indexes, futures, everything. Because if you think the prices swing with high volatility in the third week, it's going to magnify multiple times over during triple witching. You might be asking, what is triple witching? Well, triple witching is basically when you see index futures, index options, stock options, they're all expiring at the same period this Friday. And then another 3 months from now, in March, will be the next triple witching, and every 3 months out. Don't do what I did. Don't get too trigger happy, too arrogant, too comfortable, especially during OPEX triple witching, third month of the week, periods when options, boatloads of options expire and there's going to be wild price swings across the board. And that's all I have for you today. If you found anything that I talked about helpful, please be sure to subscribe for future videos. I look forward to seeing you again in my next upcoming video.